right, so I'm sorry here. I am going to take this question first, and then we'll get right into Fernando. This is going to be related to the married puts, the married put structure, of course, the radioactive trading techniques as assigned by the blueprint. Now, we probably don't have to analyze this position, but Ernie would say the same thing probably I'm about to, Will. Will says, hi, I have got a married put position on BABA that is up slightly from where he got in. Let's just go to the quotes page. So you're at a protective married put, and it's not yet bulletproofed. Okay, the stock's up slightly, but we are not yet bulletproofed. Okay, and good. It looks like there's an 8-for-1 split coming up in July. What are my options? My worry is with the put option to become a non-standard that will affect the liquidity and the implied volatility of the option. Should I just liquidate my position before the split and reestablish after the position afterwards? Okay, so what I said about what Ernie and I would say there, Will, is that in general, whenever we come across that concept there, whenever we get into a position that's coming up with a split of some kind of ratio, whether we're in a married put, whether we're in a covered call or a collar position at that time, we usually just recommend getting out of it. But you do have weeklies here, all right? So let's just say I'm going to put in an BABA 100 shares. You said it's up slightly, so I'm going to do maybe 210. It looked like it was at 217. It's not a lot of movement. And let's say I'm in the October, well, it was at 210. I'd probably 220 or 225. I'm going to go ahead with the 220. And let's say I paid $34 for this. Okay. 101.30. Okay, good. All right, so we've got some up movement. We're not bulletproof. This one's a very high risk of 9.8%. Remind me to show you. Oh, I don't think I can do it on this one. I'll try it, but remind me to show you something in just a couple minutes. I'll remind myself. You. Okay, little tease for you guys. Okay, so maybe we made an adjustment. Let's say we got $8 or $9. Let's say $9, and we lowered the cost of this down to $24, $25 per contract. Okay, we did some premium, not bulletproof, but yeah, we're holding a 6.4% risk. Okay. Now, you had mentioned that in July, Will, there's something coming up. Okay, so I don't know the date of the split, but you still got a good time period out to June. You could do the weekly, but maybe go 2 weeks out. And depending on your outlook for this position, you may get some more extra premium. Do an income method number 1 or maybe an income method number 6 on the trade to generate some income there, and maybe get it closer to bulletproof status before the event. Okay, and that might be something that you could consider because the split's not happening to July. Sam, I don't know. I don't even know if Sam is. I apologize. I don't know if Sam is saying that he thinks that you should get out of it because the split's coming up or because he doesn't like the stock. But Sam says that you should consider getting out of BABA. So thank you for that, Sam, that comment there. In general, that's what Ernie and I will do. We'll if we know the event's coming up, we'll look to get out of it before the split or having to hold. Now, you had mentioned about worrying that the implied volatility would increase or the liquidity would go down. Liquidity might be an issue, but remember, well, let's just go back to the straight married put, Will. Regardless of what the split is, and it'll probably might still remain 100 shares, but it might become an odd strike option. Okay, it might come down to about a, what would that be, like a 36 or a 31, I'm sorry, a 34.33, $34.33 strike or something like that with the 8-to-1 split. Maybe, I'm sorry, not 33, I'm sorry, sorry, not that high. It'd be about 29 or something, okay, 28. In any case, 28.33, 28.71, I think I've seen before too, but in any case, it still might represent 100 shares per contract, but the beauty of it is, remember, is that nothing is gained or lost, meaning that the value of your position and the risk that you have, the locked-in risk or the risk that you have on the position percentage-wise and the gain that you have percentage-wise will not change because of the split. Okay, it'll be the same mathematically. The minute before the split occurred and the minute after the split occurred, you will have the same exact value, okay? percentage-wise of your investment into the position. And if the implied volatility increases, you said liquidity might be an issue, and that would probably be an issue if you tried to get out of it after the split. There's not much activity on the odd size contracts, Will. I agree with that. Another reason why Ernie and I would suggest probably getting out of it. But if the implied volatility increased, you'd said that might be a possibility. Well, that would be great in a sense, because if the stock stays at the same value now that you have 800 shares instead of 100 shares at that $28 or $29 price, in that case, but the implied volatility of the option goes up, that means the option value will increase. So you could probably sell to close for a better price than what it was the minute before the split. But of course, you'll probably see implied volatility increase as you're getting up to the split date as well, almost like an earning. So that's what I would expect personally. Okay, so I cannot give you direct trading advice. You know that. I am not a financial planner or an advisor in that sense. But Ernie and my approach is, rather than deal with the headaches of it, having to deal with the different odd size contracts or things of that nature, if there's a merger even and you get stuck with owning, you had 200 shares of stock and you get 50 shares of one stock and 50 shares of another, and that as well. And Sam's thought echoes what you said as well, Will, that you can always buy BABA after the split. I think you'll get more shares in that case after the split, get out of the options and hold the shares, and then use it for protection later as well. It also adds, normally after the split it takes some time for the shares to go up, but keeping BABA is one of probably the best stock for China. That's his thoughts there. Okay, so again, I can't give direct advice on that. I said, mentioning of course that since it's not coming up to July and you've got weekly series, could get some more premium here by rolling the position. If I don't know if, Will, your situation here is the same. I put an October put out there. If you have an October or an August put, you could almost use income method number 3 in the blueprint. You could move the put into July around when that event is occurring, which would drastically lower your risk and still sell 1 week, 2 weeks, maybe 3 weeks against it before the split, and maybe get yourself to a bulletproof profitable position, realizing you're closing it before the split occurs. It's one way you could think about it. You could do some of the adjustments there prior to it, not just selling calls, but you could manipulate the put to bring it closer in as well in that case. Now, okay, Sam says he was in BA, not BABA, but he was in, going back to the Boeing, he sold the 230 calls yesterday and bought 170, bought shares at 170. Okay. All right, so now we talked about income methods. We talked about some adjustments, and I'm going to keep with this position. Yes, I am. I'm going to keep with this position for right now. Let's say this is my married put position. I've done some income methods, lowered the cost basis on the put. I'm sitting on Boeing where the stock is near my put strike price of 220, 7 points above my purchase price. Not a big move at all, 3%, 4% move. And we're still carrying a 6.4% risk. Now, what I showed actually, you're going to see a glimpse of 3 income methods. What I showed on BA for that June 26 segment was an income method number 6. It's a credit spread. We did a bear call credit spread, and the benefit is it leaves the upside open. It solves the problem of just selling the call to create a collar that has a capped gain, which brings us to Fernando's question. Normally, we don't cover these that often in the webinars because they're directly related to more blueprint owners, but we'll do it. Fernando wants to know, what is the difference, which is better, income method number 1 versus income method number 5 when considering the same CEGA model? What is the CEGA model? Well, the radioactive married put technique we're talking about is described in the blueprint. We're going to talk a little bit more about the blueprint and radioactive trading for Debra after Fernando's question. And the blueprint discusses the proper structure to use stock plus put. And then it also discusses the 12 different preferred income methods that we can use to lower that initial at risk, as we already slightly saw, and potentially bulletproof the trade, which Will was mentioning. What's bulletproof mean? That means when I pay for the remaining at risk of $15 here, $1,500 with different adjustments, I'll still have a married put position with infinite upside, but a guaranteed profit to the downside. That's what we call being bulletproof. The CEGA model Fernando refers to is that each of the 12 income methods has its own chapter in the blueprint, And the CEGA model is our decision-making process for which income method to use. And it stands for what are the current conditions of the stock and of the market itself. What are your expectations for this position going forward? Bullish, bearish, even neutral. That'll help you narrow down to the different income methods. And what are your goals for the trade? Some married puts I prefer to hold longer term, while others I'm looking to use specifically for income because they're higher volatility. Okay, so what are the goals for the position? So the conditions, expectations, and goals determine your action. So income method number one, it's simple. It's touched on a little bit in the sketch, that free white paper at radioactivetrading.com. But now that the stock has moved up and is near my put strike price, I might go out 14 to 20 days or so and simply sell a call, converting this to a collar. Okay, I'm going to go to the 225. I'm going to go to a higher strike here, and I'm going to sell it for 330, 340. Okay, so we've got my married put, still have $1,500 worth of risk. Going to go out 20 days, get about 340 of that back. All right, so I've lowered my risk to 5%. I've got a max return of 9.3%. Okay, so what Fernando's asking is there's 12 income methods. Income method number 5 is one of the riskless spread trades, a lot like income method number 6. Okay, so right away, what did we see happen here? We took the risk down from 6%, 6.4% down to 5% because we took in $340 worth of premium. If the stock is trading at 225 on July 2nd expiration, we'll have a return of potentially 9.3%. That is taking into account the theoretical price of our October 220 put on July 2nd expiration. Okay? But what else did it do? It capped the upside, and because of the magic of options, which is not that magical, remember in the married put I had infinite upside, and my put had a delta of maybe now 0.6 or 0.55. But I own the stock, which has a delta of 1. So for each dollar the stock moves up, I'm only losing 55 cents, then 52 cents, then 48 cents. The delta goes lower for each dollar that the stock goes up. I have a positive delta. Now with income method number 1, I've changed that, haven't I? Now that if the stock moves up and we get closer to expiration, this short call delta is going to 0 or to 1, depending on where the stock is. And if it's up here, now I have no more positive delta because as we get closer to expiration, every dollar we gain on the stock, we're going to give back to the short call obligation to buy it back. Meanwhile, my put delta is lowering. So as the stock's moving up, I'm losing on the put, and I've got a 1-to-1 delta match with the short call that's in the money and the stock itself. As a negative, the stock's still a positive, but the call is now a negative because I sold it. It's against me. So that's why it trails off here. Okay. So what is the advantage of income method number 1, Fernando? It gives you the most premium. We take in all 340 of that upfront premium on the position. My expectations would likely be that the stock is probably not going to go too far above 230 or drop too far below where it is right now. In that case, preferably I'd like the stock to stay right around the strike price of 225. Hopefully the call expires worthless. I don't have to buy it back or roll it. Income method number 5. The ratio call spread against the married put structure. Now in this case, what I'd likely do with a stock at 217 is I'm probably going to buy, if it's there. I have to make sure it's available, Fernando. I should have done that first, but that's okay. We'll do it anyway. I'm going to buy, yep, it's there, a 215. Slightly in the money call. That's usually the best structure for income method number 5. And I'm going to sell twice as many as the higher, but I want a credit. So I can't go to the 222.5 strike because at best I'd be getting 690, and that's the bid. So I'm in a better premium here, so I'm going to sell at 220. Now right away you see the problem. This is going to shorten my gain to the upside. Okay? So let's go ahead and do the midpoints here. We're going to buy this at 710, sell this at 2 of these at 430, Fernando, so we're going to get 860, but that means we only get $1.50 premium, $150. You get a much lower premium. Income method number 5 typically has the lowest premium in to immediately reduce the risk. We've only dropped it down to 5.8% from 6.4. And the max return, well, it's the same. I don't like this structure, by the way. I don't like the way this particular structure looks. It's too sloped for me. I'd like to see it a little bit better. But let me pause the screen for a second and try something here. I don't think it's going to work, but we are going to try it. Okay. All right. I might have to try that again later. I was going to show you something. Whoops. Lost it. Oh, it didn't like that. Okay. Yay, there we go. Okay. So interestingly, Fernando, the return is the same, but remember in that income method number 1, we are selling the 225. How are we getting the same 9.3% return percentage-wise if we're getting assigned at the capped gain of 220? Because what we did with income method number 5, nothing's naked. We did a ratio call spread, but we did a bull call debit spread between the 215 and 220 strike that we received at a credit. And, of course, we've got essentially the covered call. That extra short call is covered by the stock at 220. So if the stock is trading at 220, what do we get? We get the $5 back from the bull call debit spread and, of course, risk getting assigned at the 215 strike. Both of them have a capped gain. Both of them slope off at the end because of the cost basis. Sorry, folks. Best case scenario for both, that income method number 1 we just looked at and this income method number 5 we're seeing, is for the stock to be trading right at or just a little bit below 220. Get the maximum return for the long call that was purchased at 215. Have the 220 calls, in this case, expire worthless. Get almost $5 back for the long call. That reduces your risk by a total. Now, think about it. If I got the full $5 for that long call and we took in the 150, at the end, I'd make a max profit of $650 to reduce the risk. Okay, so that would take us down to about $800 or so in risk once it's done, if it works out. Because in order for it to work out, it has to be here, so you can sell to close that 215 strike to get the 5 points or 4 points back. It could overpay. It can overpay above the covered call if it works out. If the stock retraces, we see another retracement next week, what's the problem? Well, on the first one, you collected $3.40 of credit. Here, we only collected about $1.50. Okay? So, depending on your expectations, Fernando, that would have to be in consideration. Are you worried about another pullback and you want to reduce the risk? Is that more of your concern right now in the current market conditions as opposed to the premium and the max return? And both of them do have a capped upside. And then you see the slope off of that afterwards as well, Fernando. So is one better or worse? It really depends on the outcome. It really does. Okay? In that case. And so that's what are we going there? Oh, yes. And of course, Sam, that's why I chose the 225. 225 is more likely to go worthless than 220. But following the rules in the blueprint, the best structure for income method number 5, the most likelihood of the extra payout, is buying slightly in the money and selling slightly out of the money. For the income method number 5, if I chose to try the 225 out of the money, as you mentioned, and not be assigned, I'd only get a 40-cent credit, roughly 50 cents maybe. So this would be about 440, and I'd get maybe 480 or so at midpoint for selling 2 of the 225. So I'd only be getting 50 or 60 cents likely in that case of net credit. And then in order for the 220 to work, the stock would have to be hopefully up at 222 and a half, 224, somewhere in that range. So it's a more speculative out of the money income method number 5. I might not do it because I need that as well. Okay. Oh, and of course, yeah, in either case, if there is a large swing, Sam, in either income method number 1 or income method number 5, the gain is capped. So if we jump back another 800 points on Monday, if we move up 800 points or so, BABA is probably going to rocket up and be much higher than 220 or 225. Absolutely. Okay, so Fernando, the only way to answer the question is to be able to see into the future. I'm sorry, but that's it. Income method number 1 gives you the highest premium, which means it reduces your risk up front and you get to keep that. Now, of course, if you have to buy that call back, that's adding back into the risk. But income method number 1 gives you the highest net credit to lower the risk. Income method number 5 can give you that extra higher payout, an extra risk reduction, if and only if you get close to the maximum value for that long call, if the stock moves up to exactly where you wanted it to be for income method number 5 to make sense. Another way of saying this is income method number 5 requires, to be successful consistently with income method number 5, you need to be really good at, what do they call it? It's not pinpointing, I'm sorry, pinning. You need to be really good about pinning and saying in the next 14 days, I think the stock will be trading around 222 to 218. Now that's very speculative, but at the same time, if you're right more often than you're wrong, however you do your analysis, income method number 5 will be fantastic. But in most cases, as Sam said, we don't know if this could be up at 250 by the end of next week. We don't know if it could be back down to 200, in which case, maybe if you're watching the market well enough, which I know you are, Fernando, maybe the income method number 1 is better because you get more of that premium up front to control the risk. Both of them do have a capped upside, but 5 gives you that extra payout if things work out as you expect. Okay? All right. Now, on that note, let's sign in here. Okay, so we've been talking about a couple things here, and we've been talking about the blueprint and everything. So what is it? Well, RadioActiveTrading.com. This approach of using the married puts was developed by Kurt Frankenberg back almost 20 years ago. And he signed up for a course to learn how to trade covered calls and calendar spreads. And he followed the rules and took the course, paid a couple $1,000s for it, followed the rules, put a couple 10,000, maybe a little bit more into the market. It's told, hey, your first couple positions were doing so well. Why don't you enhance it? Why don't you start trading on margin? Trade your covered calls on margin. And then, of course, what happened? The 1 or 2 stocks he was in plummeted. He got a margin call and essentially wiped out everything he set aside. And then he said, well, where did I go wrong? Maybe I didn't go wrong, but maybe it was the structure where I bought the stock and sold the call. I capped my upside, but I left all the downside open. And someone profited on that position. So what he essentially did is he took the covered call risk-reward graph and flipped it and started writing about the proper way to do the married put structures, not shorter term, not out of the money, but going longer term and in the money to best control risk. And then, of course, the 12 different income methods came off of it. Now, RadioActiveTrading.com and at Power Options, that's where you can see the information for the Blueprint course. It's an online course now. It's not a hard book that we send out anymore. But the Radioactive Trading website, separate from Power Options but owned by the same company, this website is just dedicated to ideas, concepts, and education of the married put approach and, of course, the income methods as well. Debra wants to know, will you discuss what Fusion is? Is it a trading room, trade alerts? Well, it's not really a trading room in that case, but what we do offer here at Fusion, and what most people do, Debra, is investors who pick up the Blueprint receive a free month of Power Options that they can use anytime. And they also get the first month of Fusion discounted discounted to $10, where it's usually $69 per month. And what we found is that a Blueprint owner will typically get the Blueprint, get the course, access the course, and start going through it. And most of the time what they'll do is when they feel comfortable, they've gone through maybe the first few chapters of the structure and gone in through the first 3 or 4 income methods, they'll come in and take that first discounted month of Fusion. Now, what's available in Fusion? Well, there's a series of lessons that Kurt put together to help augment the education in the Blueprint as you're going through it. Some discussion on some of the tools that are available in Fusion and so forth, names and abbreviations. But then you get into some of the deeper stuff too. You get little insights and edges into the structure of the trades, a little bit more other examples, of course, discussions on the different income methods as you go through these lessons as well, okay? So that's available. And then the RPM report, this is similar to what you see on Power Options, Debra. The RPM report here on Radioactive Trading will give you ideas to open the new married put position, just like the search and Power Options. It's using the same exact criteria, it's just shown in a different way, okay? And you don't have the ability here on Radioactive Trading, Debra, to use the criteria, but you can change if you wanted to allocate 1, 1.5, or 2% of your total portfolio in each position and use a starting basis, and it would show you how many contracts you could afford based on those numbers that you put in, shares and contracts, Deborah. All right. In addition to that, the stock insurance tool is similar to what's in Power Options, and of course, members-only webinars and white papers. Triple E Radioactive Gains, something that Kurt wrote, comparing married puts versus long strangles, and then some good different videos here playing the bear side of the market, 5 ways to milk your radioactive profit machine, 5 ways to manage income method number 5 that Fernando was talking about, and more. And last but not least, the Open Trades Trade Tracker. This is not a trading room per se, Deborah, but it does give alerts. What we're seeing here, your view I know is a little bit different. You don't have these choices to delete RPM or the trade details here, but Ernie and I post all of our radioactive positions. So when we open a new trade, Ernie just opened one on Qualcomm yesterday. So if you're a Fusion subscriber, when Ernie opened this position yesterday, you would have received an email. A new RPM has been opened for Ernie at RadioActive Trading. And then you could log on to RadioActive Trading and see the details and any description that Ernie put in as well. So we bought 100 shares at 84.44 after the drop, paid a little bit high premium into the 90 strike put there because the implied volatility in the VIX was increased across the market. So he's taking an 8.9% risk for about 170 days. I'm sorry, not 170 days, about 260 days or so out in time. Okay, so he got in back after the decline in that case. All right, so you would receive an email with the details, or you could log on to RadioActive Trading and see the position as well. And whenever we do an adjustment or an income method, you get the email right away that you've done that as well. So going into earnings it looked really good at first, and then it looked really bad. What do I mean by that? On HDS, as we were getting close to earnings that were on the 9th, I believe. Yeah, on the 9th. I did that bear call spread that we saw for a 50-cent net credit, which left the upside open. And then I took that premium and bought a cheap out-of-the-money put. I kept the long put, but I did the cheap out-of-the-money put in case the stock fell 10 or 15%. I'd be at a profit on the position. Well, the stock closed at about where it is right now, unfortunately. It closed that day at about 33.17. It didn't gap right at the open, but during the trading day, it started to gradually move up, and it went as high as about $38, I believe. Okay, and so I sold to close this put as quick as I could to get something back, only 15 cents, still had the 6 in place with the unlimited upside available. And of course, we mentioned that. So I said when I closed the put there, we talked about what happened with the earnings. And then we did the adjustment there as well on the position, and we bought that back for the 15 cents, so it didn't go to zero. Lo and behold, of course, yesterday was yesterday, and the stock fell back down below 32. And, I'm sorry, it fell down below 34, and then it moved back up today, back up to those prices. It was at around 38, so it took a big hit. I should have left, again, as Fernando said, we can't predict the market, we can only follow it. As it was rocketing up to 38, I think selling to close this before it went to zero was a good move. But hindsight 2020, Debra, I should have just left it open for the big drop on Thursday, because I think I could have gotten $1.10 or $1.20 on this 32.5 put at some point during Thursday, if I'm not mistaken, even though it was only 7 days to expiration because the volatility spiked. So I'm leaving this set as is. I'm going to let these hopefully next week expire worthless, my bear call spread against the married put, and we'll have the risk extremely lower down in that case from the benefit of the income method number 6, and added the 12 just in case. But every Fusion subscriber received information. So that's what Fusion is. You have access to further education to help with the blueprint, basic search screens similar to Power Options, the stock insurance tool which you have in Power Options where you can help you lock in the gains on the position, members only, and then the open trades and trade tracker. And of course, you can also go back and see our historical trades, Debra, as a Fusion subscriber. Every trade I've entered as a married put since 2008, and every trade Ernie has entered as a married put posted in Fusion since 2007. And that's what Fusion is as well, of course. And you are a Blueprint owner, so you also have access to those Blueprint owner-only webinars, Debra, as well as some of the other information there as well. All right, so Debra, that's what Fusion is. It all starts with the radioactive trading limited risk technique as described in the blueprint. And then the Fusion subscription will help you to master the materials, basic search, members only for more education, and of course, follow along with Ernie's and my trades and the Open Trades Trades Tracker.